Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's turn to the economy. US consumer confidence seeing its biggest drop in nearly 4 years. The Confidence Board writing consumers became pessimistic about future business conditions and less optimistic about future income. Yelena Shulyateva of the Conference Board joins us now for more. Yelena, good morning.
Good morning.
Now, I respect the data, but the Conference Board consumer confidence figure doesn't usually move markets as much as it did yesterday. People are nervous, and they're nervous about where the consumer is at the moment. What's your read on things?
I think probably the market move comes after both the Michigan survey and the Consumer Conference survey both showed the same thing. So that is telling you the issue is a little bit more broad-based. So I think, the important thing is that expectations fell quite significantly. And what concerned me in that survey, in that particular survey, is that consumers are expecting fewer jobs available 6 months from now. So that is probably at the highest level in more than a decade. That index is telling me that, consumers don't see much availability in the job market. So we know the turnover is lower than it used to be. So, when you get laid off, when you get fired or whatever, you are finding fewer and fewer possibilities, and consumers are concerned about that.
What's the difference between normalization in the economy and outright cooling?
So we expect normalization. So this is something like 2% growth in GDP by the end of the year. But if we see tariffs, and this is something we model at the Conference Board, we see quite a big hit from the tariffs if we get a combined impact from China, Mexico, and Canada tariffs that have been discussed of about 1 percentage points on growth. So that would be a significant slowdown to a stall speed, in the economy of around 1%. So that would be a disaster, actually.
The reason why I ask is because on one hand, you could say these numbers are pretty negative. All right, go to cash, sit in your mattress. On the other hand, you could say we've actually been in a really robust growth kind of scenario with jobs being created in a significant way. And actually, this reduces some of the inflationary risk that we had heard about maybe late last year. Why is it the former more than the latter?
So I think these numbers are not catastrophic, the numbers that we saw in the Conference Board survey, because they're still in kind of a range, the bottom of the range, but still within a range that the index has been over the last several years. And over the last several years, what did we see? We saw consumer spending at quite a solid rate. So the problem here is that the decline in confidence comes at the time when the savings rate is at a very low level at 3.8%. This is very low by historical standards. And what usually happens when confidence declines, the savings rate starts to increase. And, when your income is the same or even declining because of inflation, that means only one thing. And that thing is the decline in consumer spending. Consumers have always been the driver of economic growth. And at the time when we rely on consumers so much, that means a slowdown in economic growth.
One of the big criticisms of the University of Michigan survey is that it's very political. How much political bias do you think is in the Conference Board survey?
Absolutely, that has the same issue. And if you look at the breakdown by political party, obviously Democrats are more pessimistic, even independents are more pessimistic than Republicans. But even in this, the Conference Board survey, the Republican sentiment is actually leveling off as well. So we saw it across the political spectrum in this survey.
When it comes to the write-in responses, I love these because you get a sense of what's going on in people's minds. They talk about inflation and tariffs. Is anyone talking about the fact that there might be a tax hike if TCJA wasn't extended? Is that concerning any consumers?
I don't think we're there yet. So what we see in the write-ins is the increase in policy concerns, in political concerns, in tariffs, yes. So those things that we hear on the news every day. Inflation is still a big concern, but it's being kind of like replaced by all this political agenda that we're hearing. I don't think the taxes are on the agenda just yet.
Yelena, always good to catch up. It's good to see you.
My
Appreciate
pleasure.
it. Yelena Shulyateva there of the Conference Board. Joining us now, Gardner of Stifel, to build on the conversation. Brian, welcome to the programme, sir. For people just waking up this morning who aren't as familiar with the process as you and Tyler are, can you walk us through on where we are at the moment and how much longer this might take?
All right, so it's spring training for baseball. Let's put it in baseball terms, right? In terms of a 9-inning game, we're in the first inning. It's that clear. It is very, very early in the process. This was an important step last night. It was a prerequisite for the rest of the debate that's going to play out through the rest of the spring, maybe into the summer, maybe into the fall. But we are really early in the process.
Given it's so early in the process, what does it say to you that to get over the finish line, we had to have President Trump act like the Speaker of the House, basically whipping votes last night?
I think that's a rhetorical question. I think you kind of answered it yourself. The fact that what should be a fairly easy vote just to get the process started and moving was essentially root canal last night. And very, very difficult to get enough votes to switch from no to yes. And it kind of belies the difficulty that is going to be down the road, because among the yeses were a lot of members who have concerns over the Medicaid cuts, the potential Medicaid cuts. There's nothing formal in the bill yet. But they've been speaking to the leadership, to the White House. Their concerns are out there, and if those Medicaid cuts start to materialize and become part of actual legislation, those yeses are really at play. And on the flip side, as the report just mentioned, the fiscal conservatives, they went along with it, but they want more cuts. Well, if they get their more cuts, then you're going to lose some of the other yeses, like I just mentioned, who are concerned about the deepness of the cuts. It's a very difficult, the political calculus is very, very difficult.
And they have a razor-thin majority. When you talk about those...
Like we saw last night. Yep.
Yeah, when you talk about these Medicaid cuts, it's not outright that they're talking about Medicaid, but we're talking about $880 billion that comes from the Energy and Commerce Committee. What else could it be if it's not Medicaid?
And that's the issue, right? So for people who don't understand, last night, what they voted on just has top-line numbers. There's no legislative language. There's no policy language in that document. But it assigns $880 billion in savings to the Energy and Commerce Committee. Well, you look at the Energy and Commerce Committee and see what their jurisdiction is, and you get to Medicaid. Now, where can you find offsets elsewhere, maybe even outside of that committee? And what I have pointed out to clients is that when you look at the tax cuts, there may be some tough decisions coming down the road on maybe some items not being extended, or some current policies such as maybe a cap on the corporate SALT deduction. Maybe that comes into play. Maybe a stock buyback tax, which is already in law, maybe that gets increased. So there's going to be very intense negotiations that have market impacts over the next couple of months.
Brian, the estimate from the Committee for a Responsible Federal Budget says that this current proposal will increase the federal deficit by nearly $3 trillion over the upcoming years. Is that the base case for you going forward, that this is essentially how much any kind of bill will increase the deficit?
Roughly. I think one thing that is happening, which I think is a positive, is that we're getting back to a more sustainable trajectory on debt. Debt's not going to come down. We're certainly not getting to a balanced budget, but we're getting back to an historical norm, which has really we've been out of kilter with that during COVID. And I think Scott Bessent mentioned this in your interview with him earlier in the week, which was absolutely fantastic. Just getting back to a sustainable trajectory on debt and deficits, and then dealing with longer-term problems after that, because longer-term problems, longer-term debt solutions have to include Social Security and Medicare, and those are off the table for right now.
Brian, when's the World Series? October?
October.
Yep. Okay. Brian Gardner.
Look, I mean, the speaker and the leadership, they had a big win last night. Let's not diminish that. They've been talking about a very aggressive and ambitious timeline of having this all wrapped up in the spring. I've always been a little bit skeptical about that. If they can do it, hats off to them. It would be an enormous accomplishment.
Spring
but I
training.
think. Yeah, but because of the negotiations that are going to go on, I think we're going to go on into the summer. And I think, Jonathan, we can be back here in September looking towards the playoffs at that point and still be talking about this as it gets closer to the finish line at that point.
Brian Gardner of Stifel. Brian, appreciate it, sir. Ted Maloney, the CEO of MFS Investment Management, seeing high-quality companies outside of tech and writing the following. Market concentration is the most important theme in today's market. History has shown prolonged periods of concentration are followed by equally long diversification cycles. Opportunities can often be found in recent laggards. Ted joins us in the studio for more. Ted, it's good to see you.
Great to be here. Thank you.
Are we moving out from a prolonged period of concentration towards right now beginning a long period of diversification?
Well, by its nature, it's almost impossible to think about specific timing around that. So I might have been wrong. I would have been wrong a year or two ago in thinking that the concentration was already at dangerous levels and due to unwind. So while we're not sure if the last couple of months have been the beginning of an unwind, we are reasonably sure that the level of concentration is dangerous. And I want to point out that's not a disparaging comment about any of the companies that make up the concentration. They're wonderful companies, in some cases with reasonable valuations under certain assumptions. But when you put them together, the level of concentration, and you look back in history at times when we've been even remotely close to this, it's ended badly for investors who were over-concentrated in those spaces.
When the stock goes up and to the right on the chart, a lot of people don't think it's dangerous. Talk to me about what's dangerous about it. And when you think about diversification, what does that actually mean in practice?
Well, what's dangerous about it is if one thing goes wrong for one of those companies, and because they're so interconnected, it would be likely to be a chain reaction across the companies, and not just the companies, but the equities that are incredibly highly valued. So diversification is, famously one of the free lunches in investing, and it's interesting. You have moments in time over history where people forget that because, as you say, they get enamored by up and to the right, and it's been really easy to make money in these 7 stocks for the last couple of years, so I'm going to keep doing it. It's very hard to predict what will unwind it. It is a reasonably high confidence bet that it will unwind at some point.
Yeah, there's been the sense that you actually are punished if you aren't necessarily heavily weighted in them because they've been the outperformers. I'm wondering how you position around that, whether you expect the unwind to be somewhat violent as it was, say, in the 2000 period of time, or whether it could just be what we've seen over the past couple of months, which is, a correction. It's kind of happened, but the rest of the market's done fine.
Right, exactly. I mean, I think you approach it from 2 different angles. One, bottoms up, the idea of finding a number of other stocks and bonds that you can buy to balance out your portfolio and make sure that you've got good conviction and long-term returns in there. And then top down, thinking about risk management. Again, our portfolios that have the Mag 7 in their benchmarks tend to own a decent amount of Mag 7. We're not negative necessarily on the individual stocks or the space. What we're concerned about is a risk management question, and managing risk at a portfolio level and looking at a small number of stocks driving all of the returns and most of the risk in a portfolio, we just think is dangerous.
It's notable that since December 17th, you can see that correction in the Mag 7, even though the S&P equal weight is actually up on the period. So a lot of people are doing the same. You made another point that I thought was really interesting, which is that liquidity ideas can really shift at a time where everyone's talking about private markets as being, the bastion of hope and returns. You challenge that. You actually think that in public markets, there potentially is more opportunity. Why?
Well, we just have this quaint notion that over time liquidity is a feature, not a bug. And you have moments in time where all the money will chase illiquids because of an appearance of higher returns or a value proposition that looks really compelling until people want to get their money. And we think it also depends on who the investor is, right? So large, very sophisticated institutional investors with large pools of assets should have a meaningful part of their portfolio in privates and alternatives. As it starts to become mass market, we worry about what that means for a mass market investor who might need access to his or her liquidity and might discover at the worst possible time that they don't have it.
We talked a lot about the United States and diversifying within the United States across various asset classes. Can you walk us through how you think about things internationally at a time where Europe has really started to outperform to start the year?
Yeah, we've always thought that having a global lens is the best way to invest, even if you're just focused on a given region, but certainly if you have the opportunity to invest across the world. We think that U.S. exceptionalism, at this point, regardless of whether or not you believe that it's durable or not, it's priced in. So if you look around the world, you're paying a lot for the U.S. exceptionalism bet to work out. You're paying significantly less in various pockets around the world. And that's across asset class. That's stocks, that's bonds, that's beyond that. So we think there are lots of opportunities outside the U.S., plenty of opportunities inside the U.S. as well. And it's probably never been a better time to be a skilled manager thinking about risk at a portfolio level and being able to make those trade-offs around the world.
Ted, this was smart. It's good to catch up with you.
Great to be here.
Thank you, sir. Ted Maloney there of MFS Investment Management. Let's get the market conversation. Meghan Robson of BNP Paribas joins us now for more. Meghan, good morning.
Good morning. Thanks.
We're seeing a little bit of nervousness in equities, and I stress a little bit. We're still several percentage points away from all-time highs. Are you seeing any concern in credit and credit spreads at all?
In aggregate, no concern in credit. We've been extremely range-bound since the U.S. election, so within 5 to 7 basis points for U.S. IG, for example. And really, the key drivers, despite all of the headlines that we've seen, you still have one very strong technical picture. Yield buyers are supporting the market. High yields prevent supply from rising too much. And then fundamentals are still very solid. Look at fourth quarter. We saw double-digit earnings growth for IG issuers. And so I think investors for now are focusing on those two features rather than tariffs.
Let's unpack fundamentals first and talk about fundamentals. What's the greatest threat to fundamentals at the moment?
We think it's a drop in earnings. So in order to really see high yield interest coverage get to a problematic level, which we think is around 3.5 times, it doesn't take just higher rates where we are now. You really need that drop in EBITDA of 10% or so. So the combination would really be the perfect storm of having higher rates and also a drop in earnings. But we do think it's the growth slowdown is a bigger threat for credit than elevated rates.
I thought your point there was really interesting about the fact that rates are high enough that you won't see that supply shock that could potentially send yields or spreads much wider. I am wondering on the other side, though, the demand side, whether you're seeing some potential buyers from, say, Japan fall off the map a bit because yields are rising there. I mean, there's some interesting sort of divides that are reversing the trend that have been in place, that has been in place for many years. Has that started to ebb, some of the foreign demand?
So foreign demand, to your point, is a risk this year as you continue to see the front end of the U.S. rates curve elevated. So hedging costs for those Japanese investors are still quite high, and then JGBs are rising. So that trade-off between U.S. IG and local Japan bonds is shifting a bit in favor of Japan. But for now, we haven't seen selling of US IG. I think it's a risk to watch, but not a trend that's taken hold.
One thing we've been talking about all morning is sequencing of policy. And right now we're talking about tariffs. We're talking about some of the potential cuts to the government later this year. People are expecting that maybe we'll get the reprisal of those deals that have been put on hold, the sense that maybe that will come back to the fore. Do you think that that could introduce a whole host of supply? If there are a lot of mergers, acquisitions that do get done, is that going to be funded through the credit market?
It could be. I think one interesting point is in your discussion earlier about the negative sentiment. So credit markets are not pricing in risks of this, but you are seeing the uncertainty play out in some areas. So look at IG supply for February. This could be the first month where we are actually below consensus expectations. And what's really interesting about it is following the election, you saw this boost in optimism. You thought you were going to see animal spirits, tons of M&A, and that really has not happened yet. So I think treasurers, CEOs are sort of holding back in that activity. Should we see more certainty later on in the year, I think some of that could pick up. But for now, it's something that we haven't seen so far.
People are wanting certainty when it comes to tariffs. The president this morning is saying, just let it all happen, talking about these tariffs potentially on the auto sector. What do you think, in terms of industries, are going to be the most vulnerable?
So we do think it's going to be a sector story. Our base case, we're assuming around a 40% tariff on China, 5% rest of the world. Those would be implemented gradually. So in aggregate, we think that's manageable for credit, but there are certain sectors that really stand out. So I'll highlight two. In US IG, we think autos is very vulnerable, very intertwined with Canada and Mexico. We don't think that's fully in the price. And then in the high yield market, building products. Think about tariffs on things like steel. It could be a tremendous challenge, which is not in the price at the moment.
Can we finish on autos? I won't name the name. How would you feel if an auto company came out and sanctioned a big buyback right now on the equity side? How would you feel about that?
Well, definitely not my area of expertise.
But for someone who's nervous about investing in auto credit, would that make you more nervous?
Sure. I think that, if we see re-leveraging and sort of people increasing their balance sheet in a way that is concerning, it just adds to the list of worries for the auto sector.
Trying to keep you out of trouble, all right? Meghan Robson of BNP Paribas. I'm not trying to get you in trouble.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.